Hey, good afternoon, everyone. This is Geraldo, the real estate agent with Keller Williams at the Country Club Plaza. Today, I'm at H&R Block World Headquarters in beautiful downtown Kansas City with the Master Tax Strategist, who's not only H&R Block's senior tax advisor, but also works with the IRS, Mr. Zach Beyer. Zach has been my personal tax professional for at least 6 years now and has really guided me through the entire investment process.
Well, thanks very much, Geraldo. Appreciate it. And your words are too kind. Happy to help.
Yeah, so can you kind of guide us through, Zach, just a little bit when it comes to the two different streams of income that people don't think about? They just think about rental income on a monthly basis. But also, there's the streams of appreciation on your taxes, which you taught me a lot about, as well as depreciation. Can you please just kind of decipher between the two and what that means to an investor, especially those, well, from out of state, in state, whoever they're looking for, on duplexes and single families?
Sure, yeah. So when it comes to rental properties, there's a couple things to consider. First is, like you said, what we refer to as ordinary income. So this is income that you receive when you rent the property to a tenant, and you obviously get paid for rent for doing that. That income is taxed at what are called ordinary income tax rates. So it's taxed at essentially the same rate that pay you receive through your wages is, right? And that's based on the amount of income you have throughout the year, right? So there are several different tax brackets, and depending on how large your income is, that'll determine how that rental income is determined. The rent that you receive, you can net against it any expenses you have related to the rental property. Most common things being repairs and upkeep, utilities you might pay, property taxes you might pay, mortgage interest that you have on the rental property. Things like that are expenses that you can deduct against your rental income to arrive at a net profit. The other expense that you can deduct on a regular basis is what you mentioned, which is depreciation. The way depreciation works is, obviously you're going to pay a lot of money for this rental property, but it doesn't make a whole lot of sense to expense all of that purchase price of the rental property in 1 year, because obviously you're going to keep that rental property for years and years and years. So what we do in accounting is we assign what's called a class life to an asset, like a house or a rental property, and you can take expenses of that purchase over the life of that property and refer to that as depreciation. So as an example, if you had a $100,000 rental property that you purchased, you're going to depreciate that over 27 and a half years because that's the class life for rental real estate. And instead of expensing $100,000 in the first year, you're essentially going to take 1/27th of that purchase price over the life of the rental property. So that's really the first income stream that you refer to, and that's the ordinary income you get from renting the property and the expenses you can take against it. The second income that is potential from a rental property is the gains that you might accumulate once you've held the property for a few years and then subsequently sell it. For your primary residence, you can exclude that gain from your income, but when it's a business property like a rental property, you have to include that gain in your income. So going back to our example, if you purchased a home for $100,000, use it as a rental over a 5 or 10 year period, and then 10 years later sell it for $150,000, since you made $50,000 on that purchase and subsequent sale, you now have $50,000 of capital gains income that you have to report on your tax return the year you sell the property. The one other caveat to this is when you sell a rental property, because you've taken depreciation over time, you also have to recapture that depreciation during the sale. So going back to our example, you sell the rental property for $150,000. Let's say in that 10-year period, you accumulated $10,000 in depreciation. You would add that to the sale price and actually have a gain of $60,000, $50,000 of which would be long-term capital gains, and then $10,000 would be taxed as ordinary income as the depreciation recapture. So lots of different things to consider when you own a rental property from a tax perspective and an income perspective. And that's why often working with a tax advisor is helpful, because there's lots of ins and outs that you may not be aware of, but a tax advisor is someone who can guide you along the way.
And Zach, talk about the average life that the average investor should potentially hold on to a property before they consider selling it, just in case of repairs or whatever. I think it's somewhere around 46 months. Is that about accurate before you start to get into some of that exchange?
Yeah, I mean, obviously, there's lots to consider when you're buying and selling any sort of rental investment. And don't forget like cash flow, right? So, people's situations change. Maybe you buy a rental property and you hit hard times, you got to sell it. I mean, there's tax advantage ways to hold on to properties and things like that. But at the end of the day, you got to make a living, you got to pay bills. And so, don't just do something just because you hear the tax benefits are better to do it that way. Consider your entire situation and make the decision that's best for you. Having said that, there is not necessarily an amount of time that you need to hold a rental property to take advantage of tax benefits. Just realize that there are a lot of costs associated with buying and selling properties. So, you don't want to do it on a too frequent basis because you can end up losing money that way. The real estate market typically goes up most of the time. But if you hit a bit of a dip, right, obviously you don't want to sell things for a loss. And so you've got to consider the value of your rental property when you're thinking about selling it or converting it to personal or anything.
And you mentioned capital gains. What would you say to some folks whose parents unfortunately either pass away or have to go to an assisted living, and then those kids from out of state or in state inherit that property? What's the best advice that you have for folks who kind of inherit their families' estate?
That's a great question. So when you inherit property, you also inherit what's called the basis of that property, right? So if we were going back to the first rental example I had, when you buy the rental real estate property for $100,000, that $100,000 is what's called the basis. It's what you've invested in the property. When you inherit a property, whatever basis your parents had or whoever gave you the property transfers with you as part of that transaction and becomes your new basis. As a side note, there is, in some instances, an option to elect to take the basis of the fair market value of the property on the date of death, but you need to work with whoever's handling the trust or estate for your parents to make that determination. But anyway, so you inherit that property, and when you turn around and sell it, especially if it's a house that's been in your family's home for years and years and years, there ends up being a pretty significant gain if the estate transfers the property directly to you that you personally pay taxes on. Sometimes it's advisable instead for the trust or estate to try and sell the property itself if you intend not to use it as a home, because that way the trust or estate can pay the taxes on your behalf, and it's not something that you need to worry about personally. So lots of ins and outs on that one too. Definitely recommend speaking with an expert if you encounter a situation like that that can help you navigate.
Thanks so much for all your expert advice, Zach. And if you liked it, please click like and subscribe. And please give me a call anytime when you're ready to start investing here in the home of the Chiefs, the heart of the Midwest, and the home of H&R Block, Kansas City, Missouri.